Hello, my name is Ömer Hızıroğlu. I'm the general manager of Innovent Ventures. Innovent Ventures essentially is a technology transfer fund and an accelerator. We're based in Istanbul. Basically, we've been active for 6 years. We're quite old within this ecosystem. I guess I'll have an opportunity to come back to what we really look for, but we focus on very early stage technologies, patents, IP, which is something that we haven't really talked about as much as I would like, except for your comments yesterday. So I think we're a little bit on the same boat, but at different sides of the platform. There it is.
Evan, maybe you can share your mic there, Ömer. Thank you.
Thank you. I'm Evren Üçok. I'm a partner with Early Bird Venture Capital. We are one of the largest VC firms in Europe. We are relatively sector agnostic in terms of our look, and we very much like to invest in real teams with strong businesses, typically also relatively agnostic of the stage we enter, but with a view to building great companies that we can build into $100 million plus companies, hopefully larger companies. And previous to that, I was a business angel active in Turkey, and previous to that, I was in management consulting for a very long time. So that's me. Thanks.
Great. Well, I'm really excited to have our 4 different panelists with us today because at Endeavor, one of the things I work on is actually helping entrepreneurs raise capital. And we work with about 100 different venture funds all over the world now. But when people ask me, they say, well, what are investors really looking for? I always say, well, it's a little different if you're a local fund in a market or a global fund or a corporate investor. You might have a slightly different answer. So we actually have all of those viewpoints represented on our panel, which will be great. So then my next question for you guys, as investors, what are you really looking for? What makes a great entrepreneur? What makes a great company that you want to invest in? Mustafa?
I mean, the experience that we have in Turkey is about 10 years, okay? If you
get the mic a little closer.
The experience we have in investing in startups and early stage companies is rather limited. It's 10 years. It's not a lot. So, but it's still important when you study the material, when you Google the subject, you really find a very, very substantial and well-documented information about the subject. So my first recommendation to the audience, to the entrepreneurs, would be to really study the material that is available out there, okay? But it all boils down to 3 basic things, okay? You want a great market that the entrepreneur is trying to address, okay? The market, the bigger, the better, okay? And you want a great product, okay, or service. But, and above all is you want a great entrepreneur or entrepreneurial team, okay? So this all boils down to 3 things. Great market, big market, great product or service, and the entrepreneur. There's always a debate which one of these 3 things is more important, okay?
Right.
And I really think the entrepreneur is the most important thing, okay? And because especially in the internet area, you are seeing that you start up with one idea, but you end up with a different product and service at the end that is successful. Okay? So it is the entrepreneur that makes that transition successfully from the startup idea into a successful a company. So the ability to entrepreneur to make that transition, it's what makes a successful entrepreneur from a not so successful entrepreneur. So the traits, the underlying traits behind that transition is I think the answer we're going to be looking for here, right? And I can start with some clues and my colleagues can add to it. From our perspective, we feel that the integrity of the entrepreneur is very, very critical, okay? And in the integrity area, you can include the openness, transparency, self-awareness, ability to communicate. So they're all related concepts that really it all ties together. Another very important trait of the entrepreneur for us is the domain knowledge. Okay? The better an entrepreneur knows the domain his business is going to operate, the better it is. Okay? Because only through domain knowledge an entrepreneur can make those iterations faster, can identify the opportunities better, and can respond to the customer, can understand the customer's needs and expectations better. So as a result, can make the iterations much faster and much more effective. The investments we make, the size of the opportunity I mentioned is very, very important. And to be able to make really significant success stories, you really need to go after the big ideas, okay? Mm-hmm. So to have big ideas would many of the times require that you are a contrarian, okay? So an entrepreneur should have a contrarian stand, okay? So when others are in a position to say, no, this idea is not going to work, the entrepreneur should be self-aware and reliant and confident to be able to stand and say, hey, this is going to work, and I'll make it happen. The stronger he believes in that, the higher the chances that he's going to come up with something big. However, this needs to balance with the fact that an entrepreneur should at the same time be, as I mentioned earlier, be open-minded and a good listener, okay? So the entrepreneur should listen to the people, the relevant people. His networking should be very well established, okay? So he should listen to people, he should have good mentors whom he can get advice from, and make adjustments accordingly. So, in other words, flexible persistence, flexible counter, strong position is what the entrepreneur needs to have.
Yeah. Well, the title of the panel is "What Do Investors Expect from Entrepreneurs?" Mustafa clearly expects a lot. So, Evren, let's go to you. Talking about kind of maybe those three different ideas, right? The size of the market, the potential for the product, and the caliber of the entrepreneur. How do you balance those things? What's most important when you're looking at a deal?
Tough question. Let me think about it a little bit. I mean, firstly, Mustafa, I really agree with everything he said. So he was quite thorough, but it does take a lot to first grow and then run.
That's why I started with
business,
him.
Right? That's also very important. You want the kind of person that is going to take care of that. In terms of those three things, I think, it's also a lot dependent on the entrepreneur, because what you find is that if the market might be big, but if the entrepreneur doesn't quite understand how to serve it, then it gets unserved. And you have a lot of examples of companies that have approached the markets, and then they provided a solution and they pushed it, but it wasn't the right solution and it didn't work. I mean, a great example from the States is Google. Search engines existed before Google. They were used before Google, but with Google, search became a huge component of the internet. And no company before and after has approached Google because it delivered the right product for the right market with an amazing team. So it's kind of the combination of the three. I think it's hard to say one or the other. I think they really have to complement each other. And I think there can be some instances where the market is relatively small, but the product is so amazing, the entrepreneur is still so amazing that they can create a great company out of it. I think the Turkish example is Yemek Sepeti. Certainly, if you look at many other countries, this is not such a big market. Whereas in Turkey, they came in very, very early and they built a great platform and perhaps a very, very large market share. And as a result, you have a huge, amazing company. So it's a kind of a complicated combination. I'm sorry, it's not a direct answer to the question, but I'll try to think of some other examples that might add a bit more color.
Sure. Anything else to add on that point, guys? Okay, Miles, go ahead.
So obviously it's hard coming third or fourth because a lot of these things have already been spoken about, but I would absolutely agree that when we talk about the entrepreneur, you want someone who's very passionate about what they're doing, that really believes in it, that's very driven. At the same time, when we sort of talked about the self-awareness, they need to be able to understand realistically, you know, is this something that can be done, and keep that flexibility. So as they get more information, because really at the start, they're going to have very limited information, and they have a vision on where they want to go. There needs to be a whole lot of flexibility. You really need to be able to see, well, what progress am I making, what's working, what's not, and be able to maneuver. And at the same time, one of the things I really look for is kind of a crispness of vision and thinking. There are some entrepreneurs that I talk to, and you start talking to them, and they can talk for sort of an hour and a half and sort of ramble on. And you've got other guys who are just very, very crisp, and this is really the key thing I need to work out. The rest of it is kind of details. But if I can just get this one thing worked out and get this information, then I know that I can sort of take it to the next level. And I think that crispness and clearness of vision, especially when you've got limited resources, is absolutely critical. And the guys who sort of spread themselves too thin are very sort of harried, very, you know, they wear themselves out, but they don't necessarily make a whole lot of traction. And it's those guys who really understand, okay, this is what I really need to understand, this is where I need to go. Those are the guys that do well. And I would also add to that, I think that you need different folks at different times of the organization as well. You can have a few folks who are absolutely amazing at sort of that very early stage in that idea and kind of working from a raw idea into sort of more of a product and just getting started and managing a few folks. And then when you start looking at an organization that's, you know, 150, 200 people, that may well be a very different person. And having people who kind of recognize, well, what stage are they at, and you know, and some folks can take it all the way through, but also recognizing, you know what, I've taken it from here to here, and maybe now I need to either, you know, help enhance the team to take over some of it, or maybe bring someone else in, and I'll step aside into a smaller role. So I think there are many, many different facets, but I think really this kind of clearness of vision, this passion, and the flexibility, in my mind, are some of the top things that I look for.
Yeah. Okay, I'm going to say something a little bit different. Not that I disagree with what was said, but Innovent is really the odd bird here because we focus on what we call the academic entrepreneurship. Mm-hmm. So the entrepreneur as such is in fact the professor. And I operate with we have different dynamics. And what is more important to me than an entrepreneur first is the IP. So I think unlike most of my panelists, I want to have a very strong patent, and I want to validate that patent with regards to the market. The entrepreneur who might not be the guy who invented the technology, by the way. And with regards to the academic entrepreneur, he is also different than the entrepreneurs here, especially at the e-commerce area. He has different vision. The team then is not that important. That's my job to fill that gap. But how we do that is that we try to take that technology, validate it in the market, and we have, unlike in e-commerce, alternative monetization ways. So we can license the technology as opposed to create a startup. And what I like usually in my team at one point is that having the professor who brought the know-how, the knowledge, the invention, he pairs up with a student who will then take the operational approach. In that case, I will agree with what we seek at the entrepreneur, as everybody else said. And our experience, we launched over 20 startups since 2006. And those who have been usually successful are those after a few years of operation, validating the technology, which also requires a lot of investment, by the way, again, unlike e-commerce, get some traction and they hire someone professional. And the academician sort of takes the CTO position, the original entrepreneur then takes the back seat and lets the technology fly.
So maybe turning it around just a little bit, I want to talk about this idea of smart capital, right? Because people talk about, oh, capital is out there and there's lots of places from where you can get money. But what really defines smart capital? I mean, Miles, maybe I'll start with you. You talked yesterday about sort of some of the advantages you and Baris were articulating around corporate venture, but in general, what should entrepreneurs look for in investors besides the money? What kind of value add, what kind of things are important?
Yeah, so I would say that you really want some domain knowledge, and you want to also be able to sort of use the connections that the investors have, and obviously your board as well. And you know, there was some discussion around having someone who has domain expertise, but I think also that having connectivity, the entrepreneur needs that, but also the investors do as well. So when you're in a board meeting, when you're talking about, you know, this is an area you want to go after, you want to be able to have those investors say, hey, look, I can help you by doing X, Y, and Z,
Yep.
or, you know, I wouldn't do that because I've seen this happen in the past. I would think about it this way. And so I think you really want, instead of just money and then someone who's going to maybe very smart sitting there but doesn't necessarily know anything about your domain and what the area that you're going after, you really want someone who's going to be a partner with you, who can help you as you're trying to make these tough decisions. And if you have to pivot, then, you know, they can help drive that. They can maybe get you the right connections. You know, there's one of my portfolio companies that we've got a product, and they're having a hard time with some of the packaging around a component. And you know, I was able to turn around and work with some of our packaging engineers who have very deep expertise, who have all of software ready to go that a startup can't afford. And I could turn around and say, hey, packaging engineer, can you take a look at this and try and help these guys? And you know, we've got like, you know, 2 or 3 people who can then help the startup. That's sort of one example, but you know, also these connections I think are critical. So I think you really want to identify a partner who's not just going to give you money, but really can be sort of an integral part of your success and really be a key partner to help drive you as things go forward.
Sure. So domain expertise and relationships are a network, right? So what they know and who they know can be good. Anything else to add, Mustafa?
Really, that's domain expertise and the network effect.
Evan?
I would add a couple of things to this. I would say, firstly, expectations are very important. You know, you don't want the investor to push the company in one direction and you want to go into another direction, or you know, the company needs to take its time to grow and the investor is pushing for something to happen in a year or two, or vice versa. It's very important that the investor coming in understands the entrepreneurs, what they're capable of, the company, how it should grow. A lot of people go from their own experiences, and that can be both useful and sometimes detrimental. So I think it's very, very important that on day one, everybody's expectations are similar, at least in terms of the road ahead. Obviously, there is always going to be interesting developments. Secondly, you know, I would agree definitely expertise, network, and a lot of the different assets that a good investor, VC, can provide that an entrepreneur may not have. And I think those assets can be very different, whether it's a local e-commerce company or a software company which needs to tie into Silicon Valley and make those kinds of connections. So I think it's very important to realize that an investor that's very high value add in particular venture might not be so high value add in another. We try to, want to do propaganda here, but we try to build a team that combines a lot of different elements, because what the kind of expertise and network you need for a software company is very different than the one you need for a local retail e-commerce company. Thirdly, I would say effort. You know, I at least that's my own personal view. If I won't invest into any team that I don't think is 150% dedicated, and you know, if they are like that, I will also be like that, and you know, we will be like that. So if they don't sleep, I don't sleep. If they work hard, we work hard, and you know, need to make sure that they succeed. Obviously, there is always unforeseen events, but I think everybody on the party who is committed needs to be equally committed and needs to almost religiously believe in it and give their 100%. That would be my number 3. And number 4, I would say, would be good intentions. I have seen in a lot of cases where a lot of energy spent between different shareholders and investors into kind of fighting with each other or maximizing personal value, and I find that can be very destructive. I think it's very important that the investors set an example by always thinking of the company first, and so the entrepreneurs always feel like all they need to worry about is the company, all they need to worry about is to succeed, and they will be taken care of. So I think that's also very, very important. I would say that that is one thing that where maybe independent VC firms are in a slightly better position than corporate VCs, who are typically also independent and well-mannered, but they can be perceived to have other strategic interests. It's also the case with other different types of investors. So I would say those four things are extremely important, especially for the entrepreneur.
I want to ask a follow-up question, actually, on your first point. This can be for anybody, but I do think this idea of aligning expectations and aligning incentives is super important, right? Kind of getting everybody on the same page from the start. What have been some of your experiences? Maybe what are some best practices for actually doing that with entrepreneurs? I mean, when do you sit down and kind of have these conversations, including the tough ones, right? Like about how you might not be the CEO forever, or that we might push to do this in 5 years. I mean, do you do that after you've given a term sheet, before, along the way? How do you guys manage sort of aligning expectations with your investee companies? Now I asked him a hard one. Nobody wants to answer.
We had an experience in the case of CareerNet as follows. As you may know, we have acquired CareerNet in 2 stages. First, we had 32%, and later at the end of 2005, 2006, beginning of 2006, it was increased to 100%. And the 100% acquisition process was an interesting one. During that period, a year and a half prior to that event, our partners, the founders, they showed very uneasiness about the business. They wanted to get out, and their reasoning for getting out was not really very, rational, very reasonable to me. Because they said that, the CareerNet had reached a certain level of valuation, and it is Turkey, so they wanted to cash. Okay, and my insistence to them, or my position to them, was that it is too soon to sell. Please, I almost begged them not to sell. Okay, but they had made up their mind, and so they started this process. So they end up, looking for alternatives, and we end up buying them. But what I'm trying to underline is that we really felt, and we tried very strongly to persuade to them that, hey, this is too soon to be getting out, and you still have a very fast-growing company. But the awareness of the potential valuation of companies, what it might be, was not as strong 5 years ago as it is today. Okay, I don't think they would have done something like that today. But Turkey is still in the early stages of this, ecosystems kind of concepts. So, but I am very glad to see, with the audience here, that the awareness level is heightened substantially. So the entrepreneurs of today are not going to make the same mistake. So our role as investors is really to communicate to them that, hey, we are here to make very big things happen together, okay? And our interests are aligned, and to be very straightforward and open about it, and structure deals that both sides can truly mean and live up to until the end.
Go ahead.
So I have one example where there was a misalignment, and what happened was there was effectively 2 parts of the business. There was an established business that was generating cash, and there was another side of the business which was much higher growth but didn't yet have any revenue. And so there was a disconnect between investors, because you had some of the early investors who had the early preference, who they wanted to keep the existing business around, that they could see the value from that. And then you had the later investors who saw that all of the early investors would get the preference from the value of that established business. Sure. The only way that they could see any real upside was through this higher risk, higher growth. And so you had this kind of, interesting dynamic where you had early investors wanting to really, make sure that that core business stayed around and that the new business didn't end up putting the old business at risk. And so that was interesting, kind of divergent views. And whenever we had, a lot of these board level discussions, there was always this kind of, divide between folks. So one of the things that, and this is still an ongoing process, but one of the things we're trying to do is to make sure in that case that we could kind of ring fence off the established business to make sure that that was safe while we invested in the new business and made sure that the early investors would still get their value from that established business, but yet by sort of ring fencing off this higher growth area and some of the investors who had most interest in that are putting more money into that and end up sort of getting more ownership of that while still allowing some of the upside to go back to the early investors. So this was kind of an interesting one. You don't that often get this, but because they were almost two separate businesses, we had to sort of put a lot of work into that and try and get everyone aligned. It's still an ongoing process, but I think we're making headway.
Omer?
Yeah, I think my question will be also for your previous question. Basically, what is smart money? And I think people skills is very important.
Yeah.
Which is probably stating the obvious, but going to how to manage expectations, again, dealing with professors most of the time, they could be a hard bunch to deal with. But I usually start, I'm a lawyer by trade, so nobody expects me to be very nice. Okay, so I can really play the bad cop, and that's.
So you're the lawyer investor dealing with the professor entrepreneur.
Yeah, I happen to be a general manager, but my background is law.
Okay.
So that's why actually I cannot talk sitting down. I have to stand up all the time. Anyhow, I usually ask, okay, where do you see yourself in 5 minutes? Are you going to give away your professorship? Are you giving away university? None of them, except it happened only once. Everybody says no. I say, okay, in which case, you're going to have to take the wheel for a while, but I'm going to be sitting next to you. But you have to be ready that in about a year or two, if we hit certain milestones, you're going to have to go in the back seat. And you have to agree to it. And we haven't had any real problems with that, at least on the academic sphere. I think it's very important that at the beginning, when you sit at the table and start talking about it, be very transparent, and you try to give them especially if they're first-time entrepreneurs, it's their first startup, you give them a picture of what's happening, what's the problems they're going to face, and that it's going to be hard, and they're going to have to balance two works, but ideally you would want them to quit and focus on this thing, but that's not going to happen. So you explain your problems. And once you align your problems and your vision with the professors, that tends to work pretty well.
Great. I'm going to ask one more question, and then I want to throw it out to you guys, and we'll take 2 or 3 questions from the audience. So be thinking about, here's your chance to ask a whole panel of investors anything you want to know. I'll play referee and decide if the question is allowed or not. But be bold. My question for you guys is actually thinking about the room full of entrepreneurs. What's the best piece of advice you've ever heard somebody give an entrepreneur about raising money or about working with investors? Could be something you've said or something you've heard. What's a good sort of nugget of wisdom for entrepreneurs?
May I?
Go ahead.
I would suggest that you start developing relationship with the potential investors as early as possible. Okay, don't wait until the 11th hour when you need the funds. Okay. Even if you may have just started your business, start a dialogue with the potential investors, get to know them, get to know many of them, introduce yourself and introduce your service, get some feedback, make iterations, and stay in touch with them, keep them abreast of the developments. Only because investing is a process, it doesn't happen overnight, okay? And it is best that you get to know them, and so you identify which investor is best suited for your taste, for your profile, and also it is better for the investor to get to know you better. And when you need the funds, it would be much easier for the investor to make the commitment, having observed your developments and your progress over a period of time, as opposed to in a snapshot when you would need the funds.
I think that's a great point. I think one thing you hear a lot in Silicon Valley is that investors like to invest in lines, not dots, right? So you kind of want to see the whole movie, not just the single snapshot. Anybody else? Words of wisdom for entrepreneurs?
Well, again, for my own very small universe, focus, especially again with the academic entrepreneurs. These guys tend to be extremely smart. They know their stuff. But if you're not careful, from an investor point of view, that startup can turn very easily into an engineering company, which you don't want. You want them to be scalable, create products. Focus on the problem why you launched this company, how you're utilizing your know-how, how you're placing your patents. The next step, because we are at the very early stage, we take the first risk. So my job is to a certain extent so that I have to prepare these guys for the next rounds, and at which point I usually exit. And if they do what I say, that usually, meaning they stay focused on the problem at hand, it works out pretty well.
Miles?
So I would say one thing that for me is really important is having that kind of crisp way of describing your business. You know, why is it important? Why is what you're doing different and better than what anyone else is doing? Why is it a really big opportunity? And I get some folks who just sort of dive into, you know, the hockey stick forecast, and everyone's got the hockey stick forecast, and without really understanding what the opportunity is, that doesn't really do me any good. I get some folks who send me sort of these huge presentations that are, very, very, very detailed and very, very long. And I think you need to kind of match the presentation to the stage you're at and also to your audience as well. So I really want something very crisp, so I really understand, why is this a great idea? Why is it so much better? Why is it a big opportunity? And why is the team fantastic? And I don't necessarily want, all of these forecasts going into some minutia for the next 20 years.
I had a mentor of mine once say that even if the investor gives you a 30-minute meeting, you actually only have the first 3 minutes to convince him. Then the rest of the meeting is to talk about details. But he's going to decide in the first 3 minutes whether or not he wants to hear the rest of it.
And this might be just me. Everybody has slightly different styles, but to be honest, I judge the entrepreneur to a second degree the business. So in those 3 minutes, 5 minutes, the key question I'm asking myself is, does this guy or gal know what he, she is doing? Are they on top of it? That doesn't mean they have all the answers. It doesn't mean that everything is perfect. But is this person a real entrepreneur? Are they really in it seriously? Have they done their research? And usually the answer to all of these questions is yes, if the entrepreneur is really a good entrepreneur. And if the entrepreneur is not a good entrepreneur, no amount of advice that I can give him is actually going to make a difference. So I'm looking for truly good entrepreneurs that I can support where I can, because they might have 10 things and might miss 1 or 2 things that I can give them in terms of network support, advice, etc. But if I feel the entrepreneur has 3 things going for them and they're lacking the 15 ingredients that they need to build a successful business, then that's a big turn off for me. So I guess that's not really good advice, because it's kind of saying if you're a good entrepreneur, make sure you work hard, and if you're not a good entrepreneur, try to be aware of it. And unfortunately, Turks are probably the most entrepreneurial people in the world. I often say second after Nigerians. But being entrepreneurial doesn't make you a good entrepreneur. A good entrepreneur by definition is someone who's both entrepreneurial, adjective-wise, but also can build something, build a great company, and that takes a bit more than just being entrepreneurial and excited. It takes, quite a lot of know-how and everything. I often say Rocky 3. I think those who have watched the movie know what I mean, and those who haven't, I would highly recommend. It's a kind of a quirky old movie, but always reminds me of what it takes to really succeed. So I think in that case, I typically tell them, are you really serious about this? Have you really thought this through? And I try to sometimes convince them not to be an entrepreneur, because I don't think everybody is cut out to be an entrepreneur, you know, like just like everybody isn't cut out to be a boxer. And it has become quite fashionable recently, which is great, because the more activity there is, the more great companies there are. But you know, you also see some people who are putting a lot of time and effort into something they maybe shouldn't. So I try to also advise them and warn them sometimes that doesn't make me the most popular person. Going back to your comment about people's skills, but I think it's very important to be honest, because if you're dealing with an intelligent person who wants what's best for them, if you're honest with them, you get the right end result. You know, that might mean initially maybe it doesn't go so smoothly, but you know, you get to the right outcome, which is either you help them or you discourage them. So that's my view on it.
I think that's great. I think we should all watch Rocky 3 tonight, right after karaoke. Questions from the audience. Asla, can we bring our mic?
Thank you. My original question was going to be, how soon do you know? Apparently it's 3 minutes. So let's say you meet an entrepreneur, you like them, the 3 minutes go by, the whole meeting goes by, everything's going well, you start the process. In the cases that it does fall through, where does it usually fall through? Is it the valuation, some detail of the term? Are you finding unexpected things during due diligence? Like how often does it fall through, I guess? And when it does, what is the reason?
Well,
Good question.
I mean, I think that there's so many different ways that it can fall apart. And obviously, when you're looking at deals, only a very, very small percentage end up getting all the way through. So I would say that, you know, as you go through the process, as you learn more, I think the idea can sound very interesting to start off with. And then from the sort of venture capital side, you really have to start sort of digging down and, okay, where's the value coming from? What are the competitive threats? Do you really have a different way of doing this? And often we may know about the area broadly, but we want to sort of dive down and we want to have references, we want to talk to other people, and so you can dig up all kinds of things along the way. And that also obviously affects, you know, valuation as well. If there's a great idea, but there's some sort of impediment, which means the market or the opportunity for the company is suddenly sort of cut down by a factor of 2, then the valuation has to be cut by a factor of 2. And often the entrepreneur or other investors have got an idea in their mind of what they think the valuation can be, so it could fall apart there. I think there are many different facets to valuation, not just, you know, one number, but what does the whole package look like? So it can, you know, anywhere along the way there. And then also at the end of the day, we all have to kind of go, or generally have to go through a partnership, and we have to present to a larger group. And so, you know, generally, if it's a very strong idea and you know, the person who's proposing it is very much behind it, you still may have some of the other partners who've had a bad experience in the past, or they have some other reference point, and it can fall apart there as well. Or I've also seen deals where you've got all the way through, everything's been approved, and something dramatic happens where, you know, some other company suddenly announces a product which, you know, blows away everything that you know, the entrepreneur was ready to do, and you have to kind of say, you know what, it was looking good, but now we have to kind of take a step back. So I wouldn't say there's one or two things that pretty much anything along the way, unfortunately, can derail things.
Whoa. Everybody okay? Mustafa?
Honestly, it is not a very, you know, dry cut process. Really. It's a very involved process. And, you know, you have question marks about the team, you have question marks about the product market fit, and you have question marks about the market size and the valuation. So any of these could be a reason for dropping the idea. And internally also, it's a very involved process. You may have some team members who would favor to go ahead with the project, and some others may have reservations. So it's a lot of internal dynamics as well. So it's a very time-consuming effort. Very time-consuming effort. So the due diligence process that you know is very, very comprehensive. Okay, we do prepare a lot of internal analysis, much better than what the entrepreneur himself comes up with, so that we have a better understanding of the opportunity itself. So that's a very, very time-consuming effort.
I know Endeavor selects about 2% of the entrepreneurs that we initially meet.
Mm-hmm.
Do you guys have a mental figure of all the entrepreneurs you meet or screen? How many ultimately get funded? 10%, 1%?
I think in our case,
50%?
it's probably 5%.
5%? Any idea? Ballpark?
I cannot say after 6 years. And it also depends what you mean by screen. If you think about all the projects you receive as screening, yeah, 1%, maybe less. But if those you at least schedule a meeting, it might get a little bit higher.
Mm-hmm. Omar, or go ahead.
I would say so 1 to 2% as well, just sort of rough numbers, but we certainly see a lot of opportunities, and a relatively small percentage gets through.
I agree with that. I mean, if you start from the point of screening the emails you get, etc., obviously, if you have been talking to a VC for a while and they've been taking a very careful look at you, then the chances are most likely much higher than that. So this is just a figure. I mean, it shouldn't discourage people to try to work with VCs, but they do get a lot of pitches, and you know, a lot of them are from kind of companies that are non-companies. So after you exclude that, and after you've been through the process, and you know, you've spoken to them very clearly, and they show clear interest, obviously then the probabilities are much higher. You know, more like 5%.
Sure.
You know, I would say absolutely. If you get brought in by a partner that is well respected, that could be another VC, that could be a lawyer, that could be another entrepreneur, and you have someone else who's saying, I think you should really look at these guys, you should look at what they're doing, I think it's really great. That obviously, I think, you know, dramatically sort of increases the chances of success.
I find often probabilities skew the story, right? The average age in this room might be 35, but that doesn't tell you much about an individual's age. So I think what you find is that really great companies with great entrepreneurs, you know, have much higher rates than you know, somebody who might have just seen something on TV and he wants to also sell T-shirts off the internet. So I think there's you know, could be as high as 5–10% for you know, very strong entrepreneur with a strong business, maybe even higher probability.
Sure, makes sense. Any other questions right now? I have a couple more fun ones, but I want to give you guys a chance. Oh yeah, please. Can we get you a microphone? Great, thank you.
Hi, Adi Loran from Middle East Technical University. I have a question about what's your favorite valuation approach? Do you have one? Do you use more than one? And what do you use at first? How about later?
Valuation approach. The magic black box, right? You just put it in the black box and then...
I'll tell you my the favorite valuation that was presented to me, and I won't even tell you what the business is because I don't want to give it away, but one entrepreneur once walked to me with an idea that of an established business in country X, and this person wanted to do it in country Y, but there was nothing. It's just a piece of paper. And then this person told me, well, when I do this and this and this, you know, in 3 years, 5 years, this and this will happen, and therefore in 5 years this will be a, you know, $500 million company, and if I MP with that with 20%, the value today is $20 million. That's good. So I would avoid that approach because, you know, by the way, this is a real example. I swear I'm not exaggerating. You know, okay, it was 17 million. The figure told me 17.5, I think, but literally somebody looked me straight in the eye, looked into my eyes, and for a piece of paper with nothing, like no IP, nothing, demanded a 17 million valuation. And, you know, in this situation, you know, you kind of feel like, okay, is this a real entrepreneur? You know, does this person really have sufficient life experience to run a real business, let alone grow it? So I think this is one reason why it's probably not such a wise idea to start with the valuation. It can scare off investors, because if the first sentence that an entrepreneur says is like, my business is worth $10 million and I want to sell it to you, you know, that's not a big vote of confidence in the business, right? Because you want the entrepreneur to say, it's worth $10 million today, and I think this is going to grow huge, and I want you to be a partner of it, and give me capital to help me grow it. And I think this is something that a lot of entrepreneurs often forget. Sometimes in the heat of things, and other times because actually, they actually want to sell it to you. But I would really pay a lot of attention to that if I were an entrepreneur and if I would talk to the VCs. It's not less about the number. It's much more shows a lot about how you think of the business, and it shows a lot about how you think of your relationship with your future investors and what you're trying to get out of the relationship. Now, as I was talking about expectations earlier, and this is this is kind of the thing that would give me immediately red flag. This person has very different expectations than I do in terms of, and I would probably pass that deal in 3 minutes.
Go ahead.
Okay, I'm the IP guy, so I have to bring this IP stuff here. I don't know. I'm not only one guy who had some IP-based business plan that I met here. I don't know if anybody else is there, but I also want to put it out there. When I value an investment, I have to first start by valuing patents. Patent valuation is more an art than a science. Market approach is the best, it's the most reliable, but it means that your patent is not that innovative, because it means that there are other examples that you can benchmark on. So that is always big question, especially at early stage technologies. It's more of a gut feeling than anything else. You run 3 tests, the classic market approach, cost approach, net present value, and then you see if you're more or less in the ballpark. If you have 100 million evaluation in one and you have 1 million on the other one, something is wrong. So that's one thing I wanted to say. Then we build the business plan around it. And I want to illustrate with 2 examples that goes with what he says. In one, and also about how do you manage your, what investors want from entrepreneurs. Many years ago, we were negotiating a licensing deal with a large German company with the scientist. Things were going well until, as I was flying back to Turkey, before I landed, he managed to send an email saying, well, you can have this technology, this patent portfolio for $1 billion. 1 billion. 1 billion. Billion, yes. Dr. Evil. Right? Of course, we never heard from it. So an entrepreneur can really screw up the deal. The other example, a much more recent example with the valuation, is that we invested about $150,000 as a proof of concept fund 2 years ago. So the valuation was of the company about $1 million. The big risk was patentability of the technology. So throughout that period, we managed to validate the problem, get a solid patent document. This company just last month received $4 million of financing. So that's pretty good for 2 years. Mm-hmm. And it's 2 patents. So it's really a chance thing. Also your synergy with the entrepreneur. If you see you make the same assumptions, you have the same vision, if you can work together. So it's really mostly art as far as I'm concerned than science.
Any other comments on the art evaluation?
I mean, it is very correct. The evaluation is more of an art than a science. It's a lot of times very subjective, and basically the market, the competition may end up the determining factor as to where you end up in the valuation horizon. So the more people are invested in your company, the higher valuation you can get, the less valuation you're going to get. That's as simple as that. But from the entrepreneur standpoint, valuation is important, but what is also important is how efficient you are in your capital raise expectations and needs going forward. Therefore, from an entrepreneur standpoint, instead of focusing so much on the valuation, the entrepreneur should be focusing on, the size and the timing of the capital raise, okay, and the planning for the capital expenditures. So the less you raise, the more valuable you will have, of the remaining shares, okay? So I think that should be more of a focus than the absolute valuation numbers. And on the valuation, the more competition you can create among the various investors, the better off you're going to be.
Yeah, no, I would sort of agree with a lot of that. And at the end of the day, you do a lot of calculations, and you put together sort of plans. You look at comparables, and then you, especially when you're doing sort of any kind of NPV as well, you look at a discount rate. And when you change that discount rate from 20% to 60%, it changes everything. So you can do all these careful calculations, and then you've got this big dial that you twist, and the number goes from like nothing to some huge number. And a lot of it really comes down to sort of judgment. I would agree that obviously the more competition there is, the better you are as an entrepreneur. If you're about to run out of money and you've only got one term sheet on the table, it's going to be very difficult to really sort of negotiate that up. If you've got multiple parties interested and you've got some different term sheets, then you obviously have a lot more leverage, and from your standpoint, you have a better opportunity to be able to kind of raise that up. But yeah, it's not sort of a one simple way that you come up with it. There's so many different factors that go into it. At the end of the day, it's a negotiation, and the more leverage you have, the better off you're going to be.
Cool. So we have just under 5 minutes left, and you guys have been a great audience, and it's been a long day. So I'm going to give you a reward. For the last few questions, we're going to play the lightning round. It's like the speed round of questions, okay? And here's how it works. You can only answer true or false. No other words, no explanation, no story. Just true or false. You ready?
Okay.
I did not warn them in advance, so we'll see how this goes. And it's for everybody. So here, we'll start with an easy one. The best way for an entrepreneur to get in touch with you as an investor is to cold email you a 200-page business plan. True or false?
False.
Everybody?
False.
False. Okay, good. Good start. Startups, entrepreneurs, should do due diligence on their investors. True or false?
True.
True? Everin?
True.
True. Okay, everybody agrees. Let's try a harder one. Entrepreneurs and investors can actually be friends. True or false?
True.
False.
False? True?
I would say true, but it's not very clear cut.
Okay, 3-1. Does anyone have to tell a story there, or we'll keep going? Okay, we'll keep going.
Remember, I'm a lawyer. I cannot be friends.
He's all right.
And you're the bad cop.
Entrepreneurs can be friends with lawyers. True or false? False, it sounds like. Okay. We won't pick on lawyers.
They don't have money to pay us.
Actually, here's one Pamir brought up on the last panel, which I think is interesting, and it's very debated a lot. But venture capital, or especially early stage investing, at the end of the day, really is a local game. True or false?
True.
So ask the global investor, see what he says.
I think it really depends on what your definition of local is.
That means true.
True for the local investor. Everyone, what do you say?
True for the other local investor as well.
Okay, true.
True, but have to have a global vision.
True with a global vision. Okay. How about most markets are winner take all?
False.
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 So there is something worth shooting for if you can make it into the top 2, 3, 4, 5 in a marketplace, if the market is big enough. Okay, let's see. The most exciting market for entrepreneurs and investors in the world today is Turkey.
No
Careful how you
comment.
answer. What'd you say?
I said no comment.
No comment. True or false? False.
For others, I would say false. For us, I would say true.
True. True for you guys. Okay. See Everin after the show. Okay. So we're nearing the end. I actually want to know, is Barak in the room? If not, could somebody go find him maybe? I just want to clap for him at the finish, if we could, but we'll find out. Okay. Here's an interesting one. All founders, all entrepreneurs make great CEOs. True or false?
False.
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 And why is that? Anybody want to tell us just a little bit more about that?
I mean, I would say a few words about that. There are a lot of founders who are fantastic with the idea, with the concept, with the technology, but they may be they just may not be a good manager. And so there's plenty of different roles, and I would encourage people and founders to think about, you know, this kind of self-awareness concept, that really understand what your strengths are, and it doesn't help anyone if you really don't have the right skills and you're trying to take on that role. It's not going to help anyone. I think that self-awareness. Now, some founders are fantastic and drive it all the way through, but that's certainly not not all.
From our experience, I can tell that it's also a matter of preference, okay? They may have the capacity to do that, but they prefer not to do so because they have made a lot of money and they prefer to go and enjoy life with that money, so it may be a matter of preference.
Sure.
I said false, but you know, great entrepreneurs can become great CEOs. I think they have to acquire a couple more skills, and I do know a few great entrepreneurs who are also great CEOs. So I think it's, as a rule, it's false. You cannot say that all founders are great CEOs, but I think the reverse is also false.
Okay, so the last one, which hopefully is the easiest question on the panel. It is now time for us all to clap for these panelists because it's time for dinner and drinks. True or false? True. Thank you very much.